my name is Rajesh. I'm a direct lender based in Los Angeles, and while I normally focus on investor properties, today we're just going to be looking at normal houses for normal people who want to live at them and see what's going on in the market and why I think interest rates rising is an overblown fear, and I'll actually use math to prove it. So let's look at this house right here. And before I do anything, actually, let me get out of here and show you guys how I found these. So I'm on Zillow, Los Angeles, California, for sale. Property type, single family homes. And then I have two filters here. I've gotten rid of auctions and foreclosures. I'm just looking at new construction, agent listed, owner posted. And you can see nothing else is selected other than I want these postings to be on Zillow for 90 days. That's it. Now we're going to look at different properties and see the price change. So before we even do that, here is what has been happening with the mortgage interest rates. I don't know if you can see this very clearly, so I'm going to zoom in. And over the past year, that means this same time last year, interest rates were actually higher. So you can see that compared to this time last year, a 30-year fixed rate mortgage, a conventional mortgage, it's actually 6/10 lower than it was last year, or 0.6% last year. So last year the interest rate was higher by 6/10. And if we look at it compared to the past month, it's up 0.3 of a point. So 0.3% of one interest rate. So it says 6.39. That means 1 month ago it was roughly 6.09, and a year ago it was I want to say 7, somewhere in there. 6.9 actually. 0.58 plus 6.39. Let's do some simple math here. 6.39 plus 0.58, so 6.97. So 6.99 compared to last year, it's at 6.39. And prices, what has happened to them for properties that are on the market for 90 days? So we see that this home is $2,149,000, and it's a nice looking home. Maybe it's not worth $2 million in your eyes, but maybe you're just more focused on, or maybe it is, but you're looking at it like a focus on affordability, and therefore you just think, hey, it might be worth it. I can't afford it. Interest rates are too high. But you are assuming that this property price is going to stay the same when interest rates go down to the level that you want them to. What really happens is that as interest rates go down, prices go up, and as interest rates come up, prices go down. So we can see here that this price has dropped 6.3%. And what I look at when I consider affordability is not the interest rate, but rather the monthly payment. So I've already set this up over here. Here's the price, 2.149, and I'm going to zoom in here maybe so you can see it better. There's 120. Let's go to 150. There we go. So the price is 2.149,500 right there. 80% down. We can go 96.5 for an FHA, but it doesn't really matter. The results are still going to be roughly the same. Here's your down payment. Here is your loan amount, and here is your interest rate. So we said 6.39. So let's go 6.39. And then here is your monthly payment. Now, 1 month ago, when the interest rate was what? 0.3 points lower, so 6.09. Let's see what this looks like. 39. So here is your monthly payment. The price is higher, your down payment is higher, 30,000, almost 31,000 more. Your loan amount is bigger, and your monthly interest rate, yeah, it's lower. It's lower, but your monthly payment is higher, about $300 more per month. So I think interest rates going up are a little overblown because I look at the math and I see how that actually affects monthly payments. So here is a $1.999 million home. So let's enter that in there. And now we're going to see what effect that had on prices. Here is the effect that it looks like it had on price. Not even what I believe, it's what a third party is saying. So if we go here, the price has actually come down 4.8%. So if I go 100 minus 4.8, that's 95.2. So if I were to divide that by 95.2%, that would give me the original price compared to what it was. So here is again the difference in down payment. We are looking at $399,000 now versus $420,000 then. Loan amount 1.6 versus 1.68. Interest rate 6.39 versus 6, and your monthly payment just under $10,000, whereas this is just over $10,000. So most people, they think, I'm just going to buy that home, I'm going to get the perfect interest rate, and then I'm going to hold it for the full 30 years, and I'm never going to refi. With all due honesty, that is dumb. Because when you do that, what you're doing is saying, hey, I'm committing to a fake scenario where my interest rate is ideal and my down payment is ideal and my monthly payment is ideal. In reality, pick one. Honestly, just pick one. You either want an ideal monthly payment, you want an ideal down payment, or you want an ideal interest rate. And you're not going to have all three at the same time when you first buy a house. Again, I want to clarify, this is when you first buy a house. All the people that you are looking at with a 2.75 interest rate, they have, most of them, not all of them, most of them, let me correct myself, most of them bought the house way before and then they refinanced it when interest rates dropped. So they got in when the down payment was low and interest rates were higher than what they refied it into. Then they refinanced the remaining balance into a lower interest rate, and then they got the lower monthly payment as a result, assuming they kept a 30-year term. If they went to a 15-year term, if they kept a shorter term, so let's say you bought the house 15 years ago at 5%, and then 15 years later the rate was 2.5%, well, you've paid down 15 years worth of balance, and then you're refinancing into a lower balance loan at a lower interest rate for a shorter term. So let's see, 12 times 15 is equal to 180 months. So now your monthly payments are higher, but let's say you were both at a 2.5 there. And even in this case, because the loan balance is smaller, your monthly payments are less. So you really got to ask yourself, are you really waiting for lower interest rates because you want a lower payment, or is it a vanity thing? Are you waiting for a lower interest rate because you want to say you bought the house at 3% or 2% or 4% interest? And there's no guarantee we're ever going to hit those numbers again. So while you're waiting, inflation is pushing house prices up higher on a general scale. And on the short-term scale, yeah, maybe it drops 6%, maybe it drops 5%. But I guarantee you, 10 years from now, that house is going to be, what, 20% higher, 50% higher, maybe double what it costs now. And you're going to be kicking yourself because you would have missed out on buying the house today. So figure out if your monthly payments are affordable. Don't worry about interest rates. Don't worry about anything else other than minimizing your down payment and keeping the monthly payments affordable. If you can get in at 96.5% on an FHA, or if you're a first-time home buyer, or even if you're not a first-time home buyer, if you're a first-time home buyer on a conventional loan, your LTV is going to be 97%. But let's just say you are not a first-time home buyer. Now you're at 95%. This is your down payment. Here's your loan amount. Here's your interest rate, and here's your monthly payment. This is FHA versus conventional. Theoretical low interest, theoretical high interest rate, low interest rate. Your monthly payments are still higher at the higher interest. Your monthly payments are still lower at the higher interest rate. All because what matters is loan balance. And the biggest thing affecting loan balance is the purchase price. So if you see a dip in the market, you find the house that you like at a price that you can afford based on monthly payments, and you have the down payment for it, I would humbly suggest that you get it, because you can always refinance later into a lower interest rate, and you can get shorter terms. There's no rule saying that you have to refinance into a 30-year. You can refinance into a 29-year. You can refinance into a 28-year. You can refinance into a 25-year, 20-year, 10-year, 15-year, and a 10-year. So you're not losing all those years that you initially put in. What matters is keeping your monthly payment low. So that's my suggestion to all you home buyers out there. If you can afford it, if you have the down payment, if you can afford the monthly payments, get it now while prices are going down. And even though interest rates are higher, your down payment will be lower as a result, because you're paying 3% down of a lower amount rather than 3% of a higher amount. Simple math, let's say $1 million. And let's do it apples to apples. Here is your down payment on $1 million home. It's $30,000. On $1 million home, same down percent. When prices go up, you're looking at $31,000 down. In terms of interest rates, let's say we are 6.39. And this is on a 180-year term. So let's say we actually go to 360 here. Your monthly payment is still lower. And we're just talking a $50,000 difference in price. A 5%, 4.8% difference in price. You find something that has a bigger decline, your monthly payment gets even more dramatic, despite this being a lower rate. You're paying $200 more a month versus $200 less a month for the exact same house. Exact same house, you are now paying $200 more a month just because you waited for a lower interest payment. Yeah, so there you go.